Hello, everybody. September 17th, 2014. Thanks for joining me today on the Moneybag 73 channel. Well, I'm going to talk about those two graphs that I mentioned in my last video about people who might be on the fence or wondering if they should pick up some gold and trade their paper nothings for some real money for thousands of years, as if that's not obvious enough. But some people aren't sure, so we're going to look at a couple graphs. This is not one of the two graphs I'm talking about. It is actually, but this is 2012, so it's 2 years ago. I'm going to show you an updated graph. But I wanted to start here because Zero Hedge had this article 2 years ago, September 2012. What does a $4 trillion Fed balance sheet mean for gold and oil? But we're just looking at gold. And they expected a gold price of $22.50, $1,000 higher than it is right now. Now, this red line they drew here with the red arrow actually happened. That's the monetary base, the Fed's balance sheet. Everything they've created out of thin air is actually done just like this, but gold has shot down the other way. Now, fundamentally, there's no reason for gold to be shooting down here, especially since the last few years. The demand for physical gold is like double the world production. I mean, it's insane the amount of gold that's been going into China. But that's another topic, and I may do another video on that. I've done a lot of videos on that. You can check the channel if you're interested in those videos. I've tried to cover a lot of the imports of gold into China. So anyhow, looking at this, you would expect the gold to follow along like it has since 2000 as a barometer showing you what they're doing to the fiat money that we use, the Federal Reserve notes. But it's done just the opposite. That's why a lot of us who've been predicting inflation and everything, it hasn't happened yet. I mean, we have the high prices as a result of the inflation showing up, especially in the stock market, huge bubble that they've blown up. And we see it in prices for tuition for college. I mean, it's showing up a lot of different places. It's showing up on the shelves at the grocery store. But anyhow, let's go look at this updated one. Now, this is actually, this gold price here is down near 1,200. So this is actually fallen further. This here is only at 3.5 trillion. So it's actually up here by the G. So this divergence is extremely incredible after looking at, what gold has done along with this monetary base, showing you what's going on. Here it looks like it was predicting the '08 crash between '05 and '08 as gold was going up. And then funny thing, it went down here as they tripled the monetary base. So gold just dove down, which doesn't make any sense at all. And so here it's diving down again. So if you think this blue line, they're just going to keep printing money out of thin air, paper nothings or electronic digits that aren't worth the paper they're not printed on, like Gerald Celente says. If that's just going to keep going up from here, just keep going up, and this is just going to keep going down, then I don't know, go buy some stock in Google or Apple or whatever. Go play the stock market. Just stay in paper. If you think that this is going to continue down, this continue up. If you think this is going to go back and do what it's been doing for 13 years, showing as a barometer for what's going on, then this is one good indication here that you would want to exchange some paper nothings for some real money for thousands of years. Now, the next chart I wanted to show was this one. It looks sort of similar, the divergence here, but this is the U.S. debt. The current national debt, not the unfunded liabilities, which go into the hundreds of trillions, just the current debt versus gold. And then also the debt limit, which is interesting. I mean, you see, as we come up to the debt limit, the debt ceiling, remember all that? You haven't heard about it in a while because they magically temporarily suspended it until March 2015. And what's funny about that is the terminology they use, temporarily suspend, is the same wording that Nixon used in August of '71 when he temporarily suspended the convertibility of gold into US dollars, breaking the link And the gold standard that we had, at least for foreigners, our gold standard was broken back in 33. But anyhow, so that's kind of funny. I'm thinking maybe that they're just going to not even have a debt ceiling anymore. But what the funny thing is here, though, since they temporarily suspended it right here back in February of this year, I mean, the ceiling hasn't moved in quite a while. But as the ceiling hasn't moved, the debt has continued to climb. And the price of gold has continued to fall. So that makes no sense whatsoever. You could just borrow as much as you want, but real money, you're going to have to monetize this debt and print more paper nothings. And so it's going to take more paper nothings to buy the same ounce of gold. No, according to this, it's going to take less. So with less paper nothings, you're going to be able to buy more gold. This just makes no sense at all, what you're seeing here. So if you think this red line is just going to continue on up to 20 trillion, 25 trillion, and this yellow line is going to continue on down after tracking each other for 13 years, then go buy some Google or go buy some Webvan. Webvan, remember that? Whatever, just go play the stock market. But if you think that this yellow line is going to come back up here and continue to track like it has been, gold's going to go over 2,000. It could happen real soon, according to Harvey Organ, in the next 3 months. But anyhow, I think these two graphs are really telling. And please share this with other people if you think this is helpful. And thanks for watching. I'll talk to you all soon.